How's everybody doing? You are in the strategy room on this lovely Friday night. I hope everybody's having a great time out there. I hope everybody had a great week. I have got a ridiculous amount of stuff here for everybody tonight. So I hope everybody straps in for the next hour and 15 minutes or so. We got a ridiculous amount of stuff to go through here. So I'm going to kick it off real quick, just going over a couple minutes with a couple of the episodes that I put up this week that just came out. So let's roll with, so we started off with on Sunday with episode 249, which is what is going on with data centers. I thought that was a really interesting episode because there's just a lot of things that kind of across in that data center world, whether it's commercial real estate, technology, microchips, environmental issues. There are just so many things that kind of come together and clash in that particular space. So like I said, if you haven't had a chance to check that out, go check that out. I thought that was definitely probably one of the more interesting episodes that I've done in the last few weeks. Then I did OpenAI. OpenAI wants to become a for-profit organization. How does that work? Again, I thought very interesting topic. Just I didn't want to touch on so much the AI stuff. I really wanted to really focus on more of like the inner workings, the inner politics, if you will, of what's going on there with Sam Altman and OpenAI. More, I guess you could call it from more of a case study perspective. You know, what is going on with the kind of the dysfunction, the dynamics, if you will, of OpenAI's board, Sam Altman, all the different kind of infighting going on there. You know, Sam Altman they fired him and then he brought him back and then fired the board members that fired him. And, you know, so there's just a lot of drama, a lot of interesting things going on there. And also some interesting things from like an accounting perspective, legal perspective, like what can you really do or not do with a nonprofit organization? So check that episode out if you get a chance. Then I did the rise of private credit. Private credit, that is a very, very important topic. I think that if we do have, maybe not the next market crash, but the next market crisis, I believe that private credit, if I was a betting person, I would probably put my money that if there's going to be an issue, it's going to be with private credit. Private credit is where you're going to see something break, something blow up. And so check that episode out when you get a chance, because I think that private credit is a really interesting topic, and it is something that we are no doubt going to be talking a lot about here on this channel in the months and probably over the next year or two as we move forward, because it's just such a huge thing in the financial world right now. Then I did episode 252, which was a review of ICBA's check fraud detection guide. Some interesting thing that's there just for, banks and how they can help customers with detecting check fraud, different services, whether it be technology or manual processes, that kind of thing. So maybe, check that out if you have an interest in that topic. And then I did episode 253, which was Social Security benefits. So basically, Social Security just received what's called their COLA adjustment, the cost of living adjustment. It's something that comes in every year. And kind of the big question this year was it enough? Inflation has come down as per what some numbers will tell you, or at least what the federal government is going to tell you. The inflation has come down. Therefore, the cost of living adjustment is going to be less than what it had been over the last couple of years. And what does that look like for retirees? What does that look like? What does that mean for them? In that episode, I also looked at if you've never checked out your Social Security benefits, a couple of things I talked about also in that episode are like I go to the Social Security website. I give an example of what the standard Social Security statement, the online statement you get from them. What does that look like? What are the different elements and different things that are in that statement? So if you've, like I said, and I encourage everyone, you should go to the Social Security website. You should sign up, get a login, get on their email list, because basically every year as you work, they're going to email you an updated statement every year. And then you can go on and look at it, see what it says, look at what those numbers are telling you, because obviously that becomes a much more important thing the older you get. When you get into your 40s and 50s and 60s and you're kind of, going, as you're kind of nudging closer to retirement, looking at that Social Security statement it becomes a much, much bigger thing. Not so much, in your 20s or 30s, but I just think it's a good thing. You should look at it every year. You should check it out, see what's on there, see what it's telling you, because it gives you a whole projection for what your projected benefits will be into retirement. So it's just always good to look at that, to kind of know what that looks like, what it's saying out there. So if you did not see any of those episodes, go check them out. Like I said, I think I've posted up a lot of good stuff on that. So, okay. So that's the episodes there. I will dive in toward the end. I'll take a minute and I'll kind of dive into what some of the things I'm working on for not only this week, but for probably the next couple weeks. But all right. So right now, though, I want to get into what's coming up economically next week. So next week on Monday, the 28th, we've got the 2-year and the 5-year Treasury note auction. On Tuesday, we've got the goods trade balance. We got the CB consumer confidence. Coming out at 10 a.m., we got the JOLTS job openings. We got the API weekly crude oil stock. On Wednesday, October 30th, we get the ADP non-farm employment change. We get the GDP numbers for the third quarter. We get pending home sales. And on Thursday, we've got the continuing jobless claims. We got the core PCE price index. We got initial jobless claims. And then we get personal spending. Chicago PMI in the afternoon, or not in the morning, rather. And then on Friday, finally, November 1st, we get the average hourly earnings, non-farm payrolls, participation rate, unemployment rate, manufacturing PMI, and we get the U.S. Baker Hughes total rig count. So a lot of economic information coming out this week coming up. A lot of employment information, some inflation information. Obviously, everybody's going to be looking at that GDP number on Wednesday. What does that GDP number says? So that's going to drive a lot in terms of, what the Federal Reserve, how they're looking at interest rates, what they may do or may not do with interest rates. And we're going to be talking about that in a few minutes. I've got a number of articles that I want to break down and show everybody for, what is the Federal Reserve thinking looking forward? What might they be doing? And I'm going to show you something here in just a second that is basically going to get into what our Treasury is doing right now. So, okay, so that's what's coming up in economic indicators this week. So what were some of the economic indicators that came out this week? So first thing we had was new home sales. They actually had an increase in September. So sales of new single-family homes increased 4.1% in September, and we're up 6.3% from a year ago. The Commerce Department reported the median sale price for new houses sold in September was $426,000. So what's the next thing on the list here? So existing home sales. So we had new home sales. Existing home sales decreased in September. So existing home sales decreased 1% in September, and we're down 3.5% in the past 12 months, according to the National Association of Realtors. The median sales price did rise, however, 3% from September of 2023, and the inventory of unsold existing homes rose 1.5% from the previous month. So that is actually a good thing. The rise in unsold existing homes, because we need inventory. We need inventory on the market. That's one of the things that's going to help, at least stabilize prices, maybe even bring them down a tad, is inventory. Got to get more inventory on the market. So we'll keep an eye on that and see what happens there. And then let me see if I thought I had one or two more here for everybody. Yes, here we go. Okay. Housing starts and building permits fall in September. So housing starts decreased by basically 0.5% in September, and we're down 0.7% from September 2023. According to the Commerce Department, building permits dropped 2.9% in September, and we're down 5.7% from a year ago. That is a very important thing. Obviously, building permits are the indicator of what what's in the pipeline, what's coming up here over the course of the next 6, 12, 18 months. A lot of economists, they're going to look at those building permit numbers to try to get an idea of, what does the volume and inventory of new sales for new home sales what is that going to look like going into the future? And obviously, if you've got building permits dropping, that means home builders are pulling back on their building, which is not a good sign. And then Okay, so that's all I had there, I think, for the moment, at least with those economic indicators. So, okay. So we're going to come back to that in a minute. But all right, so what I want to talk about now, I want to talk about treasury rates for a second, and then I want to talk about some CRE information. So let's get in here for a second. So, okay. So this was the PCBB. This was their blog post for today. Or I'm sorry, for yesterday. This was for yesterday. So, and it says, charge-offs are rising. What CFIs should watch out for. While asset quality is strong, rising charge-offs of CRE and credit cards suggest it's time for CFIs to revisit risk management strategies. And we discussed the trend and response to consider. So charge-off trends and implications. So the FDIC quarterly banking profile, which I showed you guys in an episode of a couple months back, this was for the second quarter, revealed an uptick among charge-offs among CFIs, a trend they simply cannot afford to ignore. So net charge-offs reached almost 0.14%, only slightly below the pre-pandemic average. The charge-off increase was most noticeable in commercial and industrial loans, also known as C&I loans, where the community bank net charge-off rate jumped by 16 basis points from 2023 to 0.37%. Given that commercial loans make up a moderate portion, 12.8% of CFI portfolios, this increase indicates stress CFI should be proactively managed. Meanwhile, asset quality metrics are still favorable despite some deterioration. The share of loans and leases 90 days or more past due or in non-accrual status inched up to 0.61%, slightly up from the first quarter, but still well below the pre-pandemic average. So we're going to talk a little bit about that more in a second. So, but CRE risks for CFI. So the office sector is dealing with ongoing issues. Higher vacancies have resulted in declining rental income, while refinancing has become much tougher due to persistently high interest rates. This has put more financial strain on commercial real estate borrowers, which is starting to spur charge-offs. Yes, it is. And I'll have, again, more information on this in just a second. So, okay, good chart here. I'm going to actually make this a little bit smaller here so you guys can kind of see this. So here we go. I think that looks a little better. Quarterly net interest margin. So we have basically assets here, up to 250 billion. Then we got 10 billion to 250 billion, 1 billion to 10 billion, 100 million to 1 billion, and then assets under 100 million. And you could see here, they've all kind of ticked back up, 20, I would say about halfway through 2021, you could kind of see we kind of hit our low point, but then they've ticked back up here coming in around the end of 2023, and they've kind of been moderate, kind of come down a little bit. But then if you look at the very end here, the tail, especially assets under 100 million, 100 million, bank size 100 million to $1 billion, you can see that we've got some tick ups there in their quarterly net interest margin. So that's that's good from that standpoint. Okay. And then what does it say down here? A stronger focus on stricter underwriting standards, tightening the terms for high risk loan segments, given the 18% jump in provision expenses from the quarter one. In other words, banks are putting more money aside in loan loss reserves. More reserves should be set aside to prepare for potential future loan losses. Now, let me ask everybody this for a minute. Why would banks not want to put more money aside into loan loss reserves? Well, the reason being is because it hurts their earnings at the end of the day. When you put more money into loan loss reserves, that takes away from your earnings, means you make less money. Means you report less, so a lot of banks, they don't love to do that because they want to, again, they want to show the best earnings they can. They want to show their investors that we had a really great year, everything's going well, and the problem is if if the losses aren't happening, or you can't really, you can't predict 100% that the loss is or isn't going to happen. Again, like I said, banks generally don't like to just put money into the loan loss reserves just for what if. They want something to, a little bit more concrete there. But like I said, I agree with this advice, though. I think putting more money in loan loss reserves right now to plan for potential loan losses is probably a good thing for a lot of banks out there. So, And then it says CFIs may want to invest in advanced data analytics tools. Yeah, definitely. So that's kind of some of the recommendations they have there. But let's take a look at a couple other articles real quick, and then I'm going to come back to this for a second. So this says, conference chatter, U.S. banks staying positive on credit quality despite some CRE weakness in the third quarter. So several U.S. lenders reported negative migrations in their commercial real estate portfolios in the third quarter, but bank executives continued to express optimism about credit quality during earnings calls. Analysts said credit trends at banks were largely stable against the backdrop of elevated rates and the increase in non-performing office commercial real estate loans at some seems manageable. While uncertainty swirls in the CRE sector, despite the prospects for lower rates to relieve some borrower weakness, cumulative credit trends were relatively stable. And then it says, office in focus. Obviously everybody's concerned about office, commercial real estate, office properties, particularly high-rise commercial real estate located in downtown centers or urban centers, however you want to say that. So that's obviously that continues to be the big thing there. And then I want to show you guys some examples here. So United Community trades loan growth for credit quality and housing loan sale. So United Community Bank took hits to loan growth and margin along with a one-time loss to de-risk its loan profile and reinvest in securities in the third quarter. The company chose to divest a long-dated and heavily subprime manufactured housing portfolio during the quarter that it inherited through an acquisition for an estimated $11 million credit loss recorded as charge-offs. Executives said on its earnings call the loss had previously been reserved. So they basically, so they sold off these loans, and basically that's one of the things I've been talking about just a couple minutes ago at the beginning. I did that episode on private credit. Now this is slightly different because private credit, generally when you're selling those loans off, they're at least performing well at the moment, and you're kind of handing them off like here. Like I said, these were described as long dated and heavily subprime. So, slightly different, but still the same strategy. You're selling loans off to, reduce your risk ultimately at the end of the day in your loan book. And they were basically willing to do this as, they were willing to take this one-time loss to kind of reposition things, which again, I'm sure will help them as they, move forward in the future. Sometimes, it helps to, even though you don't like to take the hit, sometimes it helps to keep things moving forward. So, okay. Zion's CEO expects further CRE challenges and their shifts to a multifamily loan strategy. So Zion's Bancorp CEO Harris Simmons, he anticipates further headwinds in the commercial real estate sector and a shift toward an original and sell model in 1 to 4 family loans, potentially tempering the bank's commercial loan growth. Speaking during the company's third quarter earnings call, Simmons said he is optimistic about commercial loan growth, but is tempering that excitement because of commercial real estate concerns. Given the concerns, Zion anticipates following more of an originate and sell model. I would hope that that will actually help with non-interest income, but will probably eliminate some of the growth that we've had in the 1 to 4 family, Simmons said during the call. So in other words, they're going with, especially on 1 to 4 unit properties, they're going to originate and just sell those loans. They're not going to keep those loans on their books. They're going to try to, generate some additional income, non-interest income, because that's basically you're just generating a loan and then you're selling it off. So you're not going to see that returning interest income that you would normally see on it if you kept the loan on your books. So in this case, you're selling it off. So you're basically just generating fee income for the bank. So what they're saying is like, hey, we're going to have a trade-off here. Instead of keeping the loan on our books, we're just going to originate it, sell it off, and we're going to accept the fee income. And so we're going to trade off some growth, but we're also going to trade off, we're going to lessen our risk profile at the same time. So, but furthermore, the Salt Lake City-based company's exposure to the multifamily sector led to increasing challenges in its credit quality in the third quarter. Classified loans surged 66% quarter over quarter to $2.09 billion, primarily in the multifamily CRE loan portfolio, as borrowers missed projections due to lower than anticipated leasing, rent concessions, elevated costs, and higher interest rates. Simmons also attributed the rise in classified loans to a change in approach to loan grading, which places more emphasis on current cash flow, which is the primary source of repayment, and less emphasis on the adequacy of collateral values and the strength of guarantors and sponsors. So I will always tell you the number one thing that banks should be looking at, their number one concern should always be cash flow, period. Cash flow should always be your number one concern. Everything else is secondary. You have to make sure that you have the cash flow in the property, that things are cash flowing, that basically the borrower can afford to make those monthly loan payments. That is the most important thing. Not to say that Zion's wasn't already doing that, but like I said, it sounds like they kind of made it a point to make, say, hey, we're going to make this a key focus here of our underwriting, to basically say cash flow is the primary source of repayment. That is the key thing. That's the most important thing for us. So, okay. So it is a little, I guess it's a little concerning now that you're seeing, again, you're seeing this pattern of more banks having issues in the multifamily segment as opposed to just the commercial office segment. So that, again, that's a little, concerning that you're starting to see that, because with apartments, it's a little bit different. With office, it's companies, and, not that companies couldn't afford the space necessarily, but maybe they didn't want the space or didn't need the space. So, because of remote work and all the other trends and things that were going on the last few years. And so maybe a lot of them were looking to downgrade their space, but also upgrade the quality of their space. So in other words, there was this kind of flight to A properties, but say, I don't know, let's use a law firm example. Say you were a law firm, you had 100,000 square feet. Well, they're probably sitting there going, you know what? We've got a bunch of people working remotely now. We don't need 100,000 square feet. We just need 50. But we want to kind of upgrade our digs a little bit. So we're gonna move to brand new Class A office space down the street. We're going to take 50,000 square feet, probably pay basically the same amount or maybe close to the same amount in rent. But now we have much nicer space. That's been kind of the trend of what's been going on, more so in the commercial office space. Whereas in the multifamily space, when you have apartments, right, that's really more all about the rent roll of your tenants, which are just people that you have renting apartment units. And obviously, as everybody knows, the cost of apartments has gone through the roof. And a lot of markets, your standard studio apartment is $1,500 a month. I mean, it's incredible. Your standard 1-bedroom apartment could be anywhere from $1,800 to $2,200 a month. 3-bedroom apartment could be $3,000 a month. And so on and so forth. And so the cost of renting the apartment units has just dramatically increased in just the last 4 years, and that has no doubt put a lot of strain on a lot of people out there, without question. So I would anticipate, we will continue to see kind of more of a building stress in the multifamily sector, but we'll see there. So, and I think I've got just one or two more articles on this topic before we go on to some other things here. So New York Community Bank, our lovely New York Community Bank, which is these poor guys have been dealing with an awful lot over the last year. So they cut their earnings projections after another jump in non-accruals. So New York Community Bank Corp expects non-accrual loans to remain elevated through 2026, with the damage to net interest income amplified by higher deposit insurance fees tied to asset quality. The bank now expects diluted core earnings per share to be negative in 2025 and 75 to 80 cents per share in 2026. Investors injected about $1 billion of capital into the bank back in March, and a new leadership team has been working to stabilize and reshape the company. That includes an in-depth review of its large commercial real estate portfolio, which the bank said was 97% complete in its third quarter earnings report. But non-accrual loans increased a whopping 29.5% sequentially to $2.51 billion in the third quarter, after a 143% increase in the second quarter. About 68% of the non-accrual loans are current on payments. That's kind of interesting that they're on non-accrual, but they are current on payments. Non-accrual means you're no longer accruing interest on those loans. It means you're not getting payments. So it's kind of interesting there. But the bank put some loans into non-accrual status based on doubts about future ability to pay as they come within 18 months of repricing or maturing. So that's kind of interesting. So they're kind of taking more of an aggressive approach, if you will, to this by going into this route with basically trying to, I guess, manage their credit risk. But you can see there, they put so just to keep this in context, I mean, they put $1 billion of capital into this bank, but they've got sequentially $2.51 billion in non-accruing loans or potentially non-accruing loans. So $1 billion versus $2.5 billion. You see the mismatch there. So that basically that $1 billion in capital that they raised could go away real quick if they've got to write off a lot of these loans. So we'll see what's going on there. And then I think this is the last thing I have for this particular topic, but Bank of OZK, they put $107 million land loan on non-accrual, and their cuts hold limit for new loans. So Little Rock, Arkansas based Bank OZK moved $107 million Chicago land loan to the substandard non-accrual loan bucket as it grew less patient with the sponsor's progress in recapitalizing the project. We had expected to have something resolved on that by the end of the third quarter. Chairman and CEO George Gleason said during an earnings call, and when they didn't get to a resolution, even though they're continuing work, we just decided the prudent thing to do was to write it down. Despite some migration in credit quality, Gleason viewed the third quarter as a very positive quarter of asset quality improvement as the sponsors of other projects made progress. The three other classified loans that are in the Real Estate Specialties Group portfolio all had payments and progress on them, additional reserves posted, and so forth. So we thought it was a very positive quarter on the asset quality front. So again, here we have a case where they had to write off, for a Bank of the OZK, they had to write off a very large loan, but overall they're making improvements in their credit quality across the board. So why did I just show you this string of articles basically here on this? Bank of the OZK, New York Community Bank, Zions Bank Corp, United Community, and then obviously showing you this CRE here, bank staying positive on credit quality despite some CRE weakness. I wanted to show a pattern. And I wanted to show a trend to basically say, hey, here's what banks are dealing with right now in the commercial real estate space. This is, you're seeing write-offs starting to go off, are starting to go up. Banks are they're struggling with commercial real estate right now, but it's not just commercial real estate. In particular, they're also having stress in commercial and industrial, otherwise known as C&I loans. So you're seeing stress in the C&I part of their loan portfolio. You're seeing stress in the commercial real estate part of their portfolio. But it's not just in the commercial real estate space. It's not just the commercial office properties. It's also the multifamily properties that are starting to show cracks, if you will, right now at the moment. So again, we'll have to keep an eye on kind of all this stuff to see how it unfolds. But real quick here, I want to go back to this PCBB for a second here. I want to show everybody this. Okay, this is what I wanted to talk about here for a second. So here are treasury rates, and I wanted to just point out to everybody here, if you could see, follow my little arrow here for a minute here. So we got the 10-year yield. This is 3-month, 6-month, 1-year, 2-year, 5-year, 10-year, 30-year. Okay. And this is the Fed funds market rate, is basically in the range of 4.75 to 5%. So it's hovering at 4.83 right now. SOFR, the single overnight financing rate, 4.83. For anybody who doesn't know, SOFR was the rate that effectively replaced LIBOR from a few years ago. If everybody remembers our good friend LIBOR that lasted for a long, long time. And then we have the Wall Street Journal prime rate hanging out 8% over here. So just good to know a couple of these numbers. But here's what I wanted to focus on. So here you have the yields on these treasuries. And then over here, you have the month to date change. This is what it's changed so far this month. And then here is on the far right here, we have the year to date change. Now, what I want to point out here is that look at the short-term treasuries, the 3, the 6, the 1 year. Look at the change here year to date. This is down. The 3-month is down 67 basis points. The 6-month is down 78 basis points. And the 1 year is down 51 basis points. Now, you go over here to the 2 year, the 5 year, the 10 year. And what do you notice here? just this month, we're up. The 2 years up 43 basis points, the 5 years up 49 basis points, and the 10-year is up 46 basis points. So let me ask everybody a question. What did the Federal Reserve just do like a month ago? Oh, that's right. They cut rates. So the Federal Reserve cut interest rates, but what's happening here? The interest rates are going up. They're going up. And this is a big problem because the 10-year Treasury, for anybody who doesn't know, for any of the consumers out there that don't realize, everything in your life from a lending perspective is driven by the 10-year Treasury. Your auto rate, your residential mortgage rates, your credit card rates, your student loan rates, it's all driven by the 10-year Treasury. So you have the Federal Reserve cutting rates, and since they cut rates, the 10-year Treasury has gone up 46 basis points, up to 4.24%, and basically it's going up. Now, I have talked about for a while now on this live stream, and I've done other episodes on it. I've talked about the manipulation at the Treasury. I've talked about how Janet Yellen had intentionally kept the yield curve inverted for almost an extra year longer than it should have been. And now the Treasury they've allowed the yield curve to revert back to basically normal territory. It's not fully, in my mind, technically it's not fully reverted yet because when you think about the yield curve, it's basically you take the 2-year here and the 10-year and you subtract those. So basically 4.25 minus 4.07. So you're back in a positive territory there by about 17 basis points. But the 10-year is still not higher than the 3-month. So the 3-month is at 4.73. The 10-year is at 4.24. So for me, on a highly technical basis, I still think the yield curve is inverted, even though if you're looking at the traditional 10-year and the 2-year, it's back to a positive territory. But that's not neither here nor there. The point is that the Treasury curve is heading back to a sloping, like kind of a normal sloping curve. And those Treasury rates are going to increase now because the Treasury is basically there, at least for the moment. They're done kind of manipulating the short-term Treasury rates and intentionally holding the yield curve inverted. Now, why is that important? That is important because when the yield curve reverts to positive territory, the only time in history, and I can't stress this enough, the only time in history that we've had a yield curve that was held negative, a longer and deeper inversion was right before the Great Depression. That's your basis. There is no other comparison. It was the last time we saw this was 1929. And now, in general, when the yield curve reverts back to normal territory, or positive territory rather, it generally takes it could take like 3 to 6 months before you see the recession start to kick in. Now we're about a month back into positive territory at this point. So we could be 2 months, we could be 4 or 5 months out from basically a major recession hitting. Now, the yield curve it's not a 100%, predictor of recessions to come, but it's 95% accurate. So take from that what you will. So like I said, this was just really key. I wanted to point out how these Treasury rates are fluctuating right now. And so you are going to see a very fascinating thing happening here over the next 6 months or so, 6, 7, 8 months. And this is what we're going to get into here in a few minutes with the Federal Reserve discussion. What is the Federal Reserve going to do now? Because what you're going to see is the Federal Reserve is going to continue to cut rates, but yet the treasuries are going to continue to increase. So effectively, in a not unreal way, the rate cuts that the Federal Reserve is going to do is not going to have any effect, and that is going to really. A lot of people are not going to understand that because they're not, in a certain respect, you're not being told the truth right now about what's really going on behind the scenes and all the things that are going on at the Treasury and the Federal Reserve. They're not being honest with you with a lot of stuff that's happening right now. So so you're going to have this mismatch, and you're going to have people on the news just sitting there. You're going to have, the people on CNBC are going to be sitting there scratching their head going, this is so strange, this phenomenon of the Fed cutting rates, and yet all the treasuries, the long-term treasuries are all going up, and we don't understand why this is happening. Well, hopefully now you do, because I just explained it to you. So, but okay, let's go on to, let's just run into a couple other bank topics here at the minute. So, okay, so I wanted to talk about this one acquisition here that I thought was interesting. Sandy Spring Bank. It's a very good bank down in the kind of Maryland, Virginia area. They actually just got purchased Atlantic Union Bank shares. And let's see here. I had two articles here. Which one did I want to look at? I think these both came out this. So okay, we'll look at this one first. So Atlantic Union Bank shares to acquire Sandy Spring Bancorp for $1.6 billion. So Glen Allen, Virginia-based Atlantic Union Bank shares agreed to acquire only Maryland-based Sandy Spring Bancorp in an all-stock transaction valued at approximately $1.6 billion. Following the deal's close, bank subsidiary Sandy Spring Bank will merge with and into the Atlantic Union's wholly owned banking subsidiary, Atlantic Union Bank, which will then continue as the surviving bank in the transaction. Sandy Spring had $14.4 billion in assets, very nice sized bank. $11.7 billion in total deposits and $11.5 billion in total loans as of September 30th. According to an October 21st merger release, the company has more than 50 locations, offers wealth management services through its subsidiary, Rembert Pendleton Jackson, and the West Financial Services, Inc. The combined company will have a pro forma total assets of $39 billion, total deposits of $32 billion, and gross loans of $29.8 billion, based on financial data as of September 30th. The combined entity's mid-Atlantic banking presence will be enhanced by adding 53 branch locations, and Atlantic Union will approximately double its wealth business by increasing assets under management by more than $6.5 billion. So again, I was just intrigued by this. I always had, I've had a couple friends over the years that have worked for Sandy Spring, and I have a lot of respect for that bank. I think the people there have run a very nice bank there for a long time, and they've done a great job. I mean, I can remember when that bank was, $2 billion in asset size, and they did a wonderful job of, growing that thing up to $14 billion. I guess, again, I don't know what their reasons or rationale for wanting to sell at this particular time, but I guess they figured it was a great time to sell. They certainly got a nice premium at $1.6 billion. So they sold that out, and now the combined banks, I think Atlantic Union has probably put themselves together a very nice bank there. So let's see what they had to say about this. So Atlantic Union Bank shares is hoping the sale of up to $2 billion of Sandy Spring Inc.'s commercial real estate loans. Again, what are we seeing here? Again, the trend, we're seeing the sale of commercial real estate loans will better position the pro forma company for organic growth. Atlantic Union announced they're buying Sandy Springs, Atlantic Union President and CEO John Ashbery does not want a CRE concentration ratio limiting growth. We're going to have ample liquidity in the loan to deposit ratio, Ashbery said during the company's third quarter conference call, which also covered the acquisition announcement. The loan sales will help keep the combined company's CRE loans as a percentage of risk-based assets below the recommended regulatory guideline of 300%. I kind of talked about that a little bit last week, the 100-300 rule there. CFO Robert Gorman said during the call, so following the loan sales, the company plans to use the proceeds to delever the combined company's balance sheet and reduce its loan to deposit ratio. He added, Atlantic Union's objective is to reduce the combined company's CRE loans to 285% of total capital from 295%, and reduce its loan to deposit ratio to 87% from 90%. The key message to the teams, particularly who will join from Sandy Spring into the markets in which they operate, is we will be open for business, positioned to grow. So the loan sales are expected to reduce tangible book value by 29 cents per share. Atlantic Union calculated the hit to tangible book value based on the expectation that the loans will sell at a total mark in the low 90s after accounting for a 1.5% credit mark, a 5% interest rate mark, and an additional discount related to the sale. So again, just kind of interesting. I just wanted, like I said, I just wanted to point out this merger and acquisition, but I also wanted to point out again, you're seeing what was the first thing they did. It's like, oh, okay, we're going to work on repositioning the loan portfolio a little bit. We want to bring our loan to deposit ratio back down a little bit, make that look a little stronger. So I think all in all, good move. But it's just showing the trend. Again, it's showing the trend of all the stuff that we looked at a few minutes ago, right? Okay. Moving on here to another story. Okay, we had the second bank failure. So this is pretty interesting. Second bank failure here this year and this was for Oklahoma-based First National Bank of Lindsay. So let's go. So the Office of the Comptroller of the Currency, the OCC, closed Oklahoma-based First National Bank of Lindsay on October 18th and appointed the FDIC Corp as receiver. The regulator identified false and deceptive bank records and other information suggesting fraud that indicated depletion of the bank's capital, according to a news release. The OCC also found that First National Bank of Lindsay was in an unsafe or unsound condition to conduct business and that the bank's assets were less than its obligations to creditors and others. So the banking watchdog is referring the matter to the U.S. Justice Department. So to protect depositors, the FDIC entered into a purchase and assumption agreement with the Oklahoma-based bank to assume the insured deposits of First National Bank of Lindsay. Under the deal terms, First Bank and Trust agreed to assume the insured, keyword there, insured deposits for 6.67% premium. It will also purchase approximately $20 million of the failed bank's assets, the FDIC said in a news release. So as of June 30th, First National Bank of Lindsay reported total assets of $107 million and total deposits of $97 million. About $7.1 million of the deposits exceeded the FDIC insurance limits, and this amount is likely to change once the regulator obtains additional information from customers. So basically, you got about 7.1 million in this failed bank, which basically is not, at least at the moment, is not going to be covered. But again, I think the key thing to understand here is that this was a tiny bank. I mean, $107 million in assets. I mean, that is a super tiny bank. Yeah, and the bank basically had one office. It had one branch, one office. I think the interesting thing here is that, you had, basically false and deceptive bank records, other information suggesting you had kind of a major fraud situation here that basically prompted the FDIC to come in, take control of the bank, take it over, which is, never a good situation there. And then a couple days later, yesterday, so we had this update. So Oklahoma-based First National Bank of Lindsay became the second bank to fail in 2024. The failure of First National Bank of Lindsay followed that of Philadelphia-based Republic First Bank, which I kind of covered very much a few months back when that happened. But that was a totally different situation. They faced just a lot of headwinds, and that was like the drama of all board dramas, which was fantastic. Nothing, certainly gave me a lot of stuff to talk about, that's for sure. But yeah, the drama of all board dramas there for Republic First Bank. From higher interest rates, it had $5.87 billion in assets. Now, obviously, 5.87 way larger than $100 billion in assets. Before the Pennsylvania Department of Banking and Securities took possession of it on April 21st. So the latest failure is a much smaller, like I said, reporting assets of only $107 million. So here's just a chart showing, recent U.S. bank failures. So obviously the First National Bank of Lindsay, Republic First Bank. We had a Citizens Bank. Now, you have to be careful. There's a lot of Citizens banks across the country. I could think of probably, 7 or 8 different Citizens banks that I know of. There's probably a lot more than that. So Citizens Bank, and this was looks like it's from Iowa, I think. Sac City, Iowa, if that's right. Heartland Tri-State Bank from Kansas. First Republic, not to be confused with Republic First, but First Republic Bank. This was all banking crisis from last year. First Republic Bank, Signature Bank, Silicon Valley Bank. I'm always curious why they never put Silvergate Bank. They never put Silvergate. Silvergate Bank was a $10 billion bank, and it failed before Signature and Silicon Valley Bank. And I've reported on that in some of the crypto episodes. They played, Silvergate Bank played a very key role in the whole crypto fiasco, as I call it, that happened in the first quarter of last year in 2023, and they never put it on here, despite the fact that it was a good sized failed bank. But I mean, obviously wasn't as big as these three very large. Basically these three banks were very large regional banks, and they also ranked as the second, third, and fourth largest bank failures in history, if you can believe that, because of the number of the assets, 232 billion, 110 billion, 209 billion, so those are some big banks. And then, and this is another interesting chart here, U.S. bank failures since 2008. So you can see, you go back to kind of 2010, where you had 157 bank failures, 2009 140 bank failures, 2008 28. Yeah, those were the days. Yeah, those were the days. In total, I want to say from probably 06, 07, to going through, because again in 2011 you had another 92 banks fail. You had 51 here in 2012. It wasn't until after 2012 that things really started to kind of calm down a little bit. But I think you had about 800 banks fail within that 4 or 5 year, window there, that 4 or 5 year period of time. And then obviously you can see it kind of really calm down there. And then we actually got to a point in 2018 where there were 0 bank failures, and then kind of like 4, 4, 0, 0, 5, and now 2. But you could also see by the chart here, the 5 that failed were an enormous number. $552 billion in assets in failed banks. That was bigger than at the heart of the financial crisis here. You would have to almost put together the 25 banks and the 140 banks that failed in 08 and 09 to equal the assets of what went in just 1 year last year. So just fascinating thing to look at there. So okay. So we got that. What's next? Okay, next up, want to talk about one of my favorite topics here, and that is open banking. All right, open banking. All right, hang on a second, guys. I need to get a sip here. I'm 47 minutes in at this point. I'm getting a little. I need a little drink of water. All right. Open banking. You may have heard about this a little bit this week. There's a couple of press releases that came out. Okay, so if you're not aware of open banking, I'm going to try to explain this as simple as I can. So, because it is a little bit of a complex subject. So, what the regulators, primarily the Consumer Financial Protection Bureau, the CFPB, what they want to do with open banking is and this is wild, so I get ready. What they want to do is they want to force every bank in the country to create basically what they're calling a portal, which is basically, you could think of it like a backdoor channel into the bank, where very large companies like Amazon, Google, Facebook, even X, if you will, would basically be able to come to the bank and say, hey, we're going to plug an API into the portal, and we're going to siphon out all of your customers' data. So all of your data would then get siphoned out there. And now here's how they're pitching it. Here's how the regulators are pitching it. They're pitching it like this. What does it say here? Oh, switching banks. It's about to get so much easier because we're creating this great thing called open banking, and it's going to be fantastic, and you're going to love it, and it's going to make it so easy for you to go from one bank to another. If you don't like this bank, you can switch right over to this bank like that, because you'll be able to switch. You'll have control over your data. They totally glaze over the part about you won't have any control over your data. You're going to give your data out to these big companies that are probably then going to market to you endlessly, because what they're looking for is to basically, they want to dig into your data, and they want to know everything about you. They want to know everything that you do, everywhere you go, everything you do. And I think there's something far more sinister to this whole thing. And I'll say it like this. If Congress wanted to pass a law where they said, hey, we want to be able to go into every bank in the country, and we want to be able to siphon out every customer's data because we want to know everything that they do. Obviously, no way that's happening. Because that is a violation of a number of amendments in the Constitution. Fourth Amendment, your right to privacy. That comes right to the top of the list there. But that's not going to stop the government. The government wants that information. They want to have it, and they know that trying to pass a bill would be unconstitutional, and it would be, more importantly, or not more importantly, but it would be highly unpopular. Nobody would fly with that. Nobody would fly with that. People would say, hell no, we're not doing that. But if they pass this and they basically force the banks to give this information to these big companies, now what can they do? Oh, they could just go to Microsoft or Google and they could just buy the information from them. And now they could sit there and say, well, we didn't do anything wrong. We didn't violate anything because we just simply bought the information from these other companies. We did nothing wrong. And I would be willing to, like I said, I'd be willing to bet a lot of money that is what is going on behind this whole open banking thing. But from a bank, that's a personal perspective. From a banking perspective, I don't like this I don't like open banking for a number of reasons. Number one, there's nothing in here that provides even a profit motive. It's like, why would banks want to do this? There's no profit motive. There's zero profit motive right now. Banks right now wouldn't even be able to charge these companies. They would just have to allow these companies to plug in, and then they siphon all the data out. So number one, there's no profit motive. Number two, this would cost banks a ridiculous amount of money. You're talking about millions of dollars, to build out a portal, if you will, to allow other companies to be able to plug in an API to access that information. So no profit motive, ridiculous cost. I would say most smaller banks, if you are under $1 billion, this is going to be a ridiculous cost to the bank. It's going to hurt your earnings. Might even cause a number of banks to sell. That's how big this is. This is not, and what's crazy is I don't even think a lot of banks really understand this yet. I think there's a lot of bankers out there that aren't even looking at this at all. So you got no profit motive, you got a major expense, but then what about the cybersecurity? Any cybersecurity expert will tell you that APIs they're not secure. APIs can be hacked. They will be hacked. You will have, I think, if you implemented this and you had 4,700 banks across the country now doing this, I think you would have hundreds of these banks get hacked every year. And the other thing is the cost for the cybersecurity for banks to secure this another network system, another line. Again, you're talking about a huge cost to banks to have to make sure that they're, got the cybersecurity. And then here's the coup de grace. Right now, we have a situation where regulators are really hammering on the whole relationship between banks and fintechs, because all the nonsense that happened with the Synapses bank failure, the bank Evolve IP, all the nonsense going on with that, that's really put the whole relationship between fintechs and banks, that vendor partner, if you will, relationship, that paradigm is now highly under the microscope, and regulators are saying, hey, we're really going to manage this. So they've got this whole thing under a microscope at a time when they want banks to do this open banking thing where they want to open a portal. Undoubtedly, you're going to have to hire a number of companies to help you not only build the portal, get it set up, but then make it so that it can connect with the number of any company that wants to come in with an API and connect to it, but then also protect the data. Make sure you have the proper cybersecurity there to do this. So it says here in this article from Investopedia, switching banks is about to get easier. So what are some of the key takeaways here? So a new Consumer Financial Protection Bureau rule requires banks and other financial institutions to share customer data with competitors at the customer's request, making it easier to switch accounts. Customers who switch banks could have their account information and transaction history transferred to the new provider, allowing things like bill payments to continue seamlessly. The changes will go into effect starting in 2026. So if you thought about switching your bank account or credit card for a better deal, but balked at the hassle involved, it might soon be time to give it a second look. New banking rules are about to make it easier to shop around between competing providers. The Consumer Financial Protection Bureau, the government's consumer watchdog, finalized rules Tuesday requiring banks and other financial companies to transfer customer data to a new provider at the customer's request. The changes will go into effect for the largest companies starting in April 2026, with smaller ones having until 2030 to comply. The rule changes announced last year in preliminary form are intended to make financial services more competitive and remove some of the obstacles that people encounter when they try to switch payment providers or banks to get better service or earn higher returns on their deposits or get lower rates on loans while protecting customers' privacy. Well, hold on there for a second, because this is now I'm getting fired up. Now I'm getting fired up. I love how they insinuate that banks are the ones making it more difficult for people to switch. It's not the insane amount of regulation that the regulators have put on top of banks. Banks, like for example, banks have to comply with the Patriot Act, which means they have the OFAC list. They got to, when you come in to open a bank account, they got to check you on the OFAC list. They got to follow KYC, know your customers, CIP. They got to follow EDD, advanced due diligence. You have to make sure you're complying with BSA and AML. Like there is 100 things that you have to do. That's why the boarding data, your boarding data paper is like an inch thick when you open a bank account. It's ridiculous. But again, that is the way it is because regulators have put so much onerous burden on banks to do it. It's not that banks intentionally want to make it difficult for you to switch banks. It's that they have to comply with so much. And I just think that this is laughable. The fact that they'll say like, oh yeah, well, you'll just be able to like press a button at your request and you'll just switch this information right on over. No problem, super convenient and easy, right? But as a great guy on YouTube, and for those that watch that know, super easy, barely an inconvenience. If you know that line, you'll know why that's funny. Okay. The rule, part of a broader effort by the Bureau to encourage an open banking system, could also spur more payments to be made by the FedNow and other instant payment services rather than credit card payment networks. And now we begin to see where this is all going. Yes, they want the data to be, like I said, what did I say? The government wants to be able to buy the part that they're not talking about, like they're trying to make it sound like, oh, well, this is going to be the customer requesting the information. No. There's much more to this. This is just positive spin here. That's what I want you guys to think about this article. This is positive spin. There's much more to this. They are going to force the banks to, like I said, to give this information over, and then FedNow, the Federal Reserve, other government agencies, they are going to buy this information. And they're going, and like I said, so the Federal Reserve here is already eyeing this up, going, oh, this is great. We'll get this information and we will put it all now into the Fed system. And then where does that go? That's gonna go to digital banking and digital IDs and tokenization. And we're also seeing where beneficial ownership information, another hot topic that I have talked a lot about, BOI. That's another thing that this is all like when they break these issues down, but you got to look at all these things together. When you put all these things together, that's when you start to see the bigger picture of what's going on here, where all this is going. So, all right, let me jump over to another thing here real quick. So, So this article is basically says CFPB finalizes rule for financial institutions to share consumer banking data. So the Consumer Financial Protection Bureau finalized a long-awaited open banking rule requiring financial institutions and credit card issues to share banking data with other providers at the request of consumers. The rule was proposed in October 2023 under Section 1033 of the Dodd-Frank Act. It aims to smooth the process for consumers to switch payments or credit providers, and it enables consumers to walk away from mediocre products and services. This will be an important step toward a more open and decentralized market for financial services. It will also help the United States to reclaim our tradition of ensuring that the financial system is competitive and supports households, businesses, and the economy. Financial institutions subject to the rule are required to set up the technology and procedures for data sharing following technical standards set by industry bodies recognized by the CFPB. In June, the CFPB outlined the criteria to be qualified as standard-setting bodies. The CFPB has collected comments for the first applicant, the Financial Data Exchange. Under the new rule, financial institutions will have to level up their games to defend core deposits, industry experts say. Some have expressed concerns that the liability framework is unclear. Yeah, no beep, 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 beep. That's no beep, beep, beep. Regarding who should be held accountable if the shared data is compromised. Oh, wait, what did I say? What did I just say about cybersecurity, the cost of cybersecurity, the fact that APIs are not secure, which will add operational burdens to small institutions disproportionately. Yes, banks under $1 billion in assets. Yes. So, what did the ICBA, the Independent Community Bankers, what did they have to say about this? So ICBA said that while the Consumer Financial Protection Bureau's 1033 final rule includes an ICBA advocated community bank exemption, it remains concerned about the impact of the rule on consumer data security and privacy. The 1033 final rule on sharing consumer financial data exempts community banks under $850 million in assets from a provision requiring institutions to create a third-party developer interface. Nevertheless, the CFPB's rule requires banks over $850 million in assets to bear all the costs of establishing and maintaining a developer portal that third-party companies could use to access consumer data with consumer authorization. ICBA also pushed back against remarks from CFPB Director Rohit Chopra on CNBC about ensuring non-bank fintechs protect consumer data and privacy. An ICBA statement, President and CEO Rebecca Romaine Rainey said the Bureau should focus on promoting data security at these third-party entities. Otherwise, community banks will be faced with the impossible task of vetting the security protocols of potentially thousands of fintech companies seeking to access their customer data. So basically the compliance dates here are April 1st, 2030, banks with $850 million to $1.5 billion in assets. April 1st, 2029, banks with $1.5 billion to $3 billion in assets. April 1st, 2028, banks with $3 billion to $10 billion in assets. And April 1st, 2027, banks with $10 billion to $250 billion in assets. So ICBA has repeatedly called on the CFPB to exempt community banks with less than $850 billion in assets from the rule, including a recent American Banker article. Now, I want people to understand something here. They have given an exemption here for the moment for banks at 850 billion or 850 million and under. Obviously, like I said, because that would put most of those banks out of business. I truly believe that it would put them out of business. I don't know for the banks 850 to 1.5 billion. I think a lot of them could be in danger of being put out of business. This is a huge deal. And I don't think a lot of people in banking are really, I don't think a lot of people are paying attention to this, amazingly enough. I don't think that there is enough. That's why I'm spending so much time here kind of harping on this whole thing tonight, because I don't think people are putting enough emphasis on this. And then I do have something else to share on this front because a lawsuit was filed. Here we go. The Bank Policy Institute and Kentucky Bankers Association filed a lawsuit challenging the agency's open banking rule under Section 1033 of the Dodd-Frank Act. The lawsuit filed in U.S. District Court in Lexington, Kentucky, claims that the CFPB overstepped its statutory authority and the rule jeopardizes consumers' privacy, financial data, and account security. Yes, I would agree. I would agree with that 110%. And hopefully that is the first of many lawsuits that are coming down the pike here. But we shall see. We'll have to keep an eye on this. Like I said, I'll certainly report more on the whole open banking thing that's coming down the pike here. But we'll keep an eye on it. So let's run through. Gosh, I got so much stuff to go over here. I could go. I mean, you guys may not mind. I could go for 3 hours on this. I'm not going to go for 3 hours, but I could because there's just so much. And so much stuff to go over here. Let's see if we can run through just at least a few things real quickly here. Mutuals launch Mutuals Matter campaign. An association of banking leaders from mutual banks across the country launched a new campaign highlighting the community-minded benefits offered by mutuals. There you go. OCC finalizes recovery planning revisions for large banks. So the OCC finalized revisions to its recovery planning guidelines for certain large institutions. Economic activity, little change September as per the Beige Book. Economic activity was little changed in nearly all Federal Reserve districts in September, although 2 districts reported modest growth. According to the latest Beige Book on regional economic conditions, highlights showed employment increased slightly. Inflation continued to moderate. Most districts reported declining manufacturing activity. Activity in the banking sector was steady or up slightly. Loan demand was mixed. Housing market inventory continued to expand, and commercial real estate was generally flat. ICBA bank resolution disparities show continued challenge of too big to fail. So after regulators last week closed an Oklahoma bank, what we talked about a few minutes ago, it indicated there were underlying issues of fraud that led to the closure. ICBA said it is troubled by the circumstances in which uninsured depositors of the bank were left without the same resolution that frequently applied to troubled too big to fail banks. So in other words, like I said, there was probably about $7 million there that was in what you called uninsured deposits, which would not be covered under the FDIC insurance. That's what she's referring to there. Or I should say, rather, what the ICBA is referring to there. So in a message to community bankers, ICBA President and CEO Rebecca Romaine Rainey said that while First National Bank of Lindsay, Oklahoma customers will have access to 50% of their uninsured deposits, regulators last year invoked the systemic risk exemption to protect all depositors in the failed Silicon Valley Bank, then the 16th largest bank failure in the country. So, and then it talks about too big to fail. So while the FDIC last week acted accordingly to its statutory authority and proceeding with a resolution option that was the least costly to the DIF, Deposit Insurance Fund, the disparity we continue to see in the FDIC's approach to bank failures is yet another example of how too big to fail is institutionalized in our system of banking regulations. I think she brings up a great point there. I think she brings up a very good point. Yeah, I mean, FDA, hey, man, our government right now, they love to pick winners and losers. So, okay. Digital asset crimes up in 2023. So digital asset related cases were among the most frequently cited in enforcement actions in 2023, according to the North American Securities Administration Association. So in its 2024 enforcement report, NASAA noted that last year, state regulators reported 37 enforcement actions involving digital asset staking and 155 enforcement actions involving other digital assets, both representing increases from 2022. Enforcement actions involving internet and social media fraud increased to 73 from 65, and the increases in actions involved non-staking digital assets and internet and social media fraud appears to correlate with the reported increase of referrals, complaints, reports, and enforcement matters involving pig butchering, which I covered in an episode a few months back, and other similar scams. In a written statement for a recent congressional hearing on crypto-based romance confidence scams, also known as pig butchering, ICBA said the scams exemplify the hazards of unregulated crypto for consumers and the banking system, and a coordinated effort is needed to combat these scams. CFPB companies must follow the FCRA rules. So when tracking employees, so the Consumer Financial Protection Bureau issued a circular that said that companies using third-party consumer reports must follow Fair Credit Reporting Act rules. The CFPA said that employers that use consumer reports, both when hiring workers and for subsequent employment purposes, must comply with the FCRA obligations, including the requirement to obtain a worker's permission to procure a consumer report, the obligation to provide notices before and upon taking adverse actions, and a prohibition on using consumer reports for purposes other than the permissible purposes described in the FCRA. FHA seeks feedback on housing proposals. So the Federal Housing Administration posted 2 draft mortgagee letters on its drafting table for feedback. So see what happens with that. I will cover the OCB put out a report on their kind of, I think, semi-annual interest rate risk report, which the OCC published its fall 2024 report on interest rate risk data gathered during examinations of mid-size and community banks at Federal Savings Association. The interest rate risk statistics reports provides data on risk exposures and limits for banks by asset size and charter type, including minority deposit institutions. So I will take a more in-depth look at that report in an individual episode. It's too much to go over here tonight in the live stream. And let's see here. Where am I at here? So, all right, let's take a look at a couple other things here real quick. I still got a few more minutes. Okay. I thought this was pretty cool. So new FTC penalties await businesses with hard to cancel subscriptions. So if anybody's heard about this, this is basically this is called the click to cancel rule. I think this is pretty cool. So business owners soon will need to give their customers an easy way to cancel their subscriptions or risk big penalties. So the Federal Trade Commission last week finalized its so-called click to cancel rule, reforming what has been called the negative option feature of contracts or any contract provision under which the buyer's failure to cancel means continued acceptance of the contract, or for many consumers today, a subscription. For example, not canceling a media or meal prep subscription means the consumer keeps getting charged for it until they cancel. Complaints about hard to cancel subscriptions have been increasing, the FTC said, rising from 42 complaints per day in 2021 to nearly 70 complaints per day this year. So basically what they want to do is they want to make it so, like, if you have an app, that there's like a button in the app and you can just click that button and boom, it just cancels your subscription automatically, which I think is absolutely fantastic. So I think that is a really cool thing. I think that could work really well. I hope this is something that will come to fruition soon, because there's a lot of things, there's a lot of apps, a lot of subscriptions and stuff out there that are very hard to, very hard to cancel, tough to get out of. So, all right, what are some other things here? So, wait, let's go back there for a second. Okay, CRE investors prepare for a busier year of buying and selling in 2025. So all the commercial real estate stuff we talked about earlier, commercial real estate transaction activity is picking up. Even ahead of the Federal Reserve's interest rate cut last month, the U.S. commercial real estate market saw almost $60 billion in transaction volume in the second quarter, a 31% bump from the first 3 months of the year, according to CoStar Group. And in a third quarter survey of industry participants by commercial real estate data company Altus Group, the percentage who picked deployed capital as a primary focus over the next 6 months surged 11 percentage points to 31% for the previous quarter, when it was 20%. Meanwhile, the percentage of respondents who said they were pausing or de-risking their portfolios dropped 5 and 6 percentage points respectively. So okay, see a little bit of an uptick. So which property types will provide popular? There will be disparity among sectors as expected increased investments and deal activity plays out. Among them, the office segment remains a sector that'll be tricky for investors to navigate in the coming quarters and years. Jones said for the past year to 18 months, high net worth individuals and family office funds have been the most active in buying office properties at discounts of 50% or greater. Wow, that is crazy. 50% or greater. So we'll see. We'll see how that continues to play out. A couple of SBA articles here real quick. Like the SBA wants to spur billions in investments with new license award. This is kind of interesting. The Small Business Administration and the Department of Defense, the DOD, they want to drive billions of dollars in private investment in small business through a new program. So the Small Business Investment Company Critical Technology Initiative is a joint effort of the agencies to attract private investment in technology and research critical to economic and national security. The program debuted in September of 2023, but this week, the DOD and the SBA said they had awarded license under the program to 13 investment funds that collectively plan to raise about $2.8 billion in private capital matched by SBA guarantees to invest in roughly 1,000 startups and small businesses. The SBA and DOD entered into this historic initiative to leverage the SBA's longstanding Small Business Investment Company program and its recent transformation so that we can ensure Americans maintain its global competitive edge in critical technologies. SBA Administrator Isabel Guzman said in a statement, these early strong results and expanded network of investors will provide Americans innovators, producers, and supply chains with the vital funding needed to meet challenges and advance our national and economic security. The joint initiative relies on changes the SBA made to its SBIC program, both to streamline the application process and create a new class of guarantees called accrual debentures that are geared toward long-term investment funds, that's kind of interesting. Under the SBA and DOD's joint initiative, the designated investment companies are allowed access to up to $175 million in SBA accrual debenture loans. Licensed funds also gain access to DOD-provided program-related initiatives and benefits, the agency said in a statement. The agency said the number of licensed investment companies is expected to grow over time, with additional applications accepted in quarterly filing windows. Okay, interesting. And then the SBA rolled out a couple other changes to some of the other programs. And then another article here basically just says that the SBA faces a big challenge in servicing its COVID-19 disaster loan program. I have covered this in other one-off episodes. But yeah, basically the SBA's got a huge problem with delinquent loans right now. And that problem only seems to be getting worse. So there you have that. I think I got that. And unfortunately, I don't think I really have time to get into a lot of the other stuff there. Let me just check real quick if there was any other. If there was anything else I wanted to get in here with you guys real quick. Okay. Oh, this was interesting. I'm going to be doing an episode on this. So this is and I'll get out of this for just a second here. So this is a study released by the Federal Reserve Bank of New York indicates that banks have been adjusting the terms of commercial real estate mortgages in a bid to hide losses, which leads to increased risks to the financial system. Reuters reported banks extended and pretended their impaired CRE mortgages in the post-pandemic period to avoid writing off their capital, leading to credit misallocation and a buildup of financial fragility. According to the study noted that banks held 50.7% of the 5.8 trillion CRE market as of the fourth quarter of 2023. So yes, I will be doing an episode just on that report, and that will be coming out probably in this next week or so. Let's see here. I'm going to be doing some discussion on the Federal Home Loan Bank, what's going on with that. And I think that's kind of it for right now for this week, man. Woof. And I had a lot of stuff that I did not even get a chance to get to tonight. I wanted to talk more about the M&A market. I had some just, kind of stuff that, what's the Fed going to do? China. Oh, you know what? I do want to talk about this for 1 second if I could find this. Nope. Okay, right here. So last thing basically for tonight here. So China doubles down on efforts to boost economy with further rate cuts. So China's central bank cut their benchmark interest rates for the third time in 2024 as it steps up efforts to reduce borrowing costs and boost economic growth. A 25 basis point cut to both the 1-year and 5-year loan prime rates was announced on October 21st. Following the cuts, the 1-year LPR, the common benchmark for corporate and household loans, stands at 3.10%. While the 5-year LPR, the mortgage benchmark, is 3.60%, its lowest level ever. The rate cut confirms a policy pivot toward further monetary easing aimed at revitalizing the economy. The property sector is expected to be the primary beneficiary, maybe, of the recent stimulus package that includes cuts to both mortgage and down payment rates, along with the government's announcement that it will purchase land in existing housing estates. The measures will revive growth in the fourth quarter of 2024 and help avoid a sharp deceleration in 2025. In late September, the government announced a series of measures that included allowing homeowners to renegotiate with their banks to reduce interest rates on existing mortgages and lowering the down payment requirement on second homes to 15% from 25%, bringing it in line with that for first homes. The bank's reserve requirement ratio was also cut by 50 basis points to boost liquidity. So, the reason why I bring this up is because, China continues to have a lot of. Oh, you know what? I probably should have been sharing that article. Sorry, guys. Sorry, guys. I messed up on that one. So, here was the article right here. Just not much. It was just a one-page article, basically just going over, what was going on there with China. But like I said, just wanted to share that one thing. Last thing there. So China, we're keep an eye on that. But China and Japan obviously continue to have a whole bunch of issues, and that's going to continue to go on for a while, and we'll see what happens there with that. Some of the stuff that I basically did not get to cover tonight, I'll try to cover those with other episodes. I'll probably save some of this maybe for the live stream next week, depending on what news we have coming out. Like I said at the beginning, we have a ton of economic data information coming out, economic indicators coming out next week. So I would basically just tell everybody, like I said, love doing the live stream every Friday night here so usually go for about an hour and 15 minutes every Friday night. We're on about an hour and 20 minutes here now. So like I said, I'm going to wrap this up here in just a minute, but so I hopefully everybody's enjoying the live stream. Like I said, please come hang out with me on Friday nights at 7:00. Hopefully, like I said, I'm sharing a lot of information here on the banking world and the world of financial services, just trying to keep everybody up to date as to what's going on, why things are happening. Hopefully get some good information out of all this. But definitely, and what I try to do is I try to put out 5 to 6 episodes a week, generally just one episode a day. Length of individual topic episodes is generally about 10 to 20 minutes in length. I try to keep them somewhat shorter so that people can just enjoy them as, maybe if you're driving to work or driving home or you're at the gym or, whatever the case may be. But like I said, hopefully check out some of those episodes. I think I've put up a lot of really good content over the last few months. I've got special series on there, whether it's the Lords of Easy Money, the crypto series, movie reviews, documentary reviews, interviews. Got a ton of great stuff and content up there on the channel. Go check out the YouTube page whenever you get a chance. Obviously, the podcast is available on all the major podcast platforms. And like I said, I should have some other stuff coming out. I'm working on an upcoming series called, basically like an economic history series. Basically, we're going to focus on the first season, if you will, is going to be focused on the 20th century. We're going to look at a number of different topics and things that happened throughout the 20th century and how it affected the world of finance, how it affected the world economy, the global economy, the U.S. economy. So, and I think people will find a lot of those topics very interesting. So, but with that being said, I'll wrap up with this. Remember, we are on YouTube, Rumble, and all the major podcast platforms. Please make sure to like, share, and subscribe. That really helps the channel. I thank all of my listeners and followers immensely. I really appreciate all of you out there for taking a few minutes out of your day to spend 5 minutes with me. Joey Bag of Donuts here. So again, I hope everybody has a wonderful weekend. Have a great week out there. I will be back next week, same bad time, same back channel. Thank you for being in the strategy room, and I will see everybody next week. Have a